Imagine you're living in a remote, semi-urban town in India.
Right.
Let's really paint this picture, because honestly, getting the context right is the only way this whole deep dive makes sense today.
Absolutely. You really have to step out of the urban bubble for this one.
Yeah, exactly. You aren't sitting in like a high-rise in Mumbai or some air-conditioned tech park in Bengaluru. You are out in the districts.
Way out.
And the nearest physical brick-and-mortar bank branch is miles away. It's perhaps a really long bus ride that eats up, half your day and a decent chunk of your daily wage just to get there.
Just walk through the door.
Right. But you have a very real, very pressing need right now. Maybe you need to open a bank account to receive a direct benefit transfer from the government, or perhaps you need to access a pension for an elderly parent who physically can't make that bus journey.
And the immediate reaction from anyone sitting in a major metropolitan hub is usually, well, just download the app, right?
Oh, always.
There's this massive assumption that digital infrastructure has just entirely erased physical distance.
Yeah, the tech world loved to tell you that the smartphone solved literally everything.
Right.
But out here, in this reality, navigating a complex, multi-page digital form on a localized app with a spotty, buffering internet connection just isn't feasible.
It's incredibly frustrating.
Even if the connection were flawless, you might not have the exact formal documentation ready. Or, more fundamentally, you just aren't comfortable executing a high-stakes financial transaction into the digital void.
Exactly. The digital void is a great way to put it.
If you are dealing with a government subsidy that represents like a month's worth of food, you don't want to just press a button on a screen and hope it worked.
No, you want a receipt. You want a person.
You want to hand a piece of paper to a human being, watch them process it, and have them look you in the eye and say, yes, the money is in your account.
That psychological friction is a massive barrier. I mean, it is a completely different reality from the seamless one-click urban digital experience we all just take for granted.
Completely different.
The gap between a digitized government backend and an analog citizen sitting in a village is just vast.
And that gap is exactly our focus today. We're exploring a really fascinating solution to that exact problem. Our stack of sources today unpacks the business model of a company called BLS E-Services Limited, or BLSE.
Right.
They operate as an asset-light service aggregator. So basically, they are the physical bridge in India's massive digital revolution.
The physical layer.
Yeah. And our mission for this deep dive is to look at how this company turns millions of tiny, localized microtransactions into a nationwide distribution network. We need to figure out what their true competitive advantages are, how they actually extract profit from like 5 rupee transactions, and the existential risks they face as India's technology ecosystem continues to evolve.
What's fascinating here is that BLSE is really just a proxy for an entire, largely invisible infrastructure layer.
Invisible to most of us anyway.
Exactly. When we analyze them, we are analyzing the assisted digital distribution layer. This layer is absolutely vital for the ongoing formalization of India's economy. Without it, the government's grand digital initiatives, they just stall at the last mile.
Okay, let's unpack this, because when you and I hear the word infrastructure, our minds immediately go to poured concrete.
Right, bridges, roads.
Yeah, we think of highways, suspension bridges, maybe 5G cell towers. But this is a totally different beast. This is what the sources refer to as phygital infrastructure.
Digital. Physical and digital.
Right. It's a physical network of people, small storefronts, and local merchants that is entirely dedicated to delivering digital services. It's an incredible concept, but let's move from the abstract to the concrete reality on the ground. What exactly is the product here?
Well, that's the thing.
Like, if I walk into a shoe store, I walk out with a box of shoes. If I pay for a software license, I get a program downloaded to my hard drive. BLSE isn't selling a piece of software, and they aren't handing you a physical consumer good.
And if you misunderstand the product, the entire financial model of the company will seem like nonsense.
Okay, so what is it?
BLSE sells assisted service delivery. The product is the assistance itself. It is the act of a human being guiding another human being through a digital checkpoint.
So it's an action, not an object.
Exactly. And that action breaks down into 3 very distinct service lines, according to the sources.
Okay, let's hear them.
The first, and arguably the foundational one that builds the local trust, is Business Correspondent services.
Business Correspondent.
Yeah, you'll see this abbreviated as BC services. This is where BLSE acts as the outsourced last-mile banking channel for major financial institutions.
Let me make sure I'm visualizing this correctly. This is essentially doing the things a bank branch would do, but without the vault, the security guards, and the marble floors.
That's exactly the mechanism. We're talking about basic, but absolutely critical financial transactions. Opening a savings account, depositing physical cash, withdrawing cash, transferring funds between accounts.
The day-to-day stuff.
Right, checking a balance or handling Aadhaar-enabled payment system activities. Major public and private banks desperately need to reach these remote or semi-urban customers.
To meet their targets, right?
Yes, to meet financial inclusion targets and to gather rural deposits. But building a fully staffed, air-conditioned branch in a sparsely populated agricultural hub is just economically ruinous for them.
The math just doesn't work.
The return on investment for a physical building just isn't there. So the banks outsource that physical touch point to companies like BLSE.
Which solves a massive capital expenditure problem for the banks. I mean, they get the rural reach without the real estate footprint.
Precisely.
So that is the banking side, the cash in and cash out. What is the second major bucket of services?
The second is e-governance, or government-to-citizen services, GTC.
G2C, got it.
This is entirely about helping everyday citizens access public utility services and government platforms.
Okay, so this is the bureaucratic layer. We are talking about getting a PAN card, the Indian Tax Identification Number, or interacting with Aadhaar services, the National Biometric Identity System.
Or accessing state pension portals, passport application assistance, or even just making municipal utility payments.
Right.
Over the last decade, state and central governments in India have aggressively digitized these systems. The back end is incredibly sophisticated, but the citizen at the front end still needs human help.
Because the interface is intimidating.
Very. They need someone to explain the interface, scan and upload the correct supporting documents, and verify their identity biometric.
Ah, right, the scanners.
Yeah, and think about it. If a rural worker types in their name with a slight spelling mismatch compared to their legacy documents, the digital system rejects it instantly.
Just a hard stop.
Exactly. The human agent is there to prevent that rejection before it happens.
And that leads us to the third service line, which seems to be where the retail magic actually happens. The sources call this value-added or assisted digital services.
This is the commercial cross-selling engine.
The cross-sell.
Yeah. Once a customer is physically standing in the BLS store, interacting with a local agent they trust to handle their tax documents or their banking, that agent has a captive audience.
They're just standing there waiting.
Right. They can offer a whole suite of other digital services. Ticketing for train or bus travel, point-of-sale services, assisted e-commerce, where the agent helps you order something online, and you pay them in cash.
Wait, really? People order online but pay the agent in cash?
Absolutely. Then there's bill payments and, crucially, microinsurance.
Oh, wow. So they are essentially monetizing the foot traffic. The government service brings the person through the door, and the agent sells them a train ticket while they are waiting for their receipt to print.
It's brilliant.
But when we look at these three buckets together, banking, e-governance, and retail cross-selling, it brings up a rather complex dynamic regarding who the actual customer is.
It does get a bit layered.
Because there seem to be two completely different layers of customers interacting with BLSE simultaneously.
The business operates a unique two-sided network. The direct customers, the entities signing the massive enterprise contracts and actually writing the checks to BLSE, are the major banks and the state governments.
Right.
But the end users, the people whose behavior dictates the volume of those transactions, are everyday citizens.
So the government is paying BLSE for the logistical reach, but the citizen is the one consuming the actual service.
Exactly.
It makes me think of an API. You know how in software architecture, an API, an application programming interface, is just a piece of code that allows two different software programs to talk to each other?
I like where you're going with this.
Right, because Program A and Program B don't speak the same language naturally. They have totally different data structures. So the API sits in the middle, takes a request from Program A, translates it into a format Program B understands, and passes it along.
An API removes the friction of incompatible systems.
Exactly. And BLSE is essentially a human API.
A human API.
Yeah. You have a citizen standing in a dusty storefront with a very real-world analog need. They have physical rupee notes in their hand, or a dog-eared physical birth certificate, or they just have a verbal request spoken in the local dialect.
And on the other side?
On the other side, you have the State Bank of India, or a government tax portal with a highly secure, rigidly structured digital backend that only understands precise data inputs. The two just cannot communicate natively.
No, they can't.
BLSE's physical touchpoints are the human API that connects the analog citizen to the digital backend.
It is a really strong framework because, unlike a software API that just runs silently in the background, a human API has to manage emotional and psychological variables.
The human element.
Right, the agent isn't just translating data, they're translating trust. And the sheer scale of this operation is what demands our attention today.
Let's hear the numbers.
The sources detail over 1.21 lakh touchpoints across the country.
Over a lakh. Wow.
Yeah. They operate over 1,000 dedicated BLS stores, manage over 29,700 business correspondents, and have deep integrated ties with 16 major banks. In the financial year 2024 alone, this network processed over 130 million transactions.
At 130 million.
Let that sink in.
But let me stop you right there, because if you read the global financial press, India is heralded as the absolute pinnacle of digital payment adoption.
Oh, universally.
Everyone talks about UPI, the Unified Payments Interface. It is this incredible, frictionless, ubiquitous digital payment system. Smartphone data in India is among the cheapest in the world. Adoption is staggering.
It is.
So if the country is already tapping their phones to buy a cup of tea on the street corner, why is a network of 1.21 lakh physical agents processing 130 million transactions? Isn't the whole premise of this human API destined to just vanish as soon as everyone gets a slightly better smartphone?
It's a fair question, but you are conflating basic digital awareness with full digital fluency, and that is a mistake many macro analysts make. It is one thing to know how to scan a static QR code at a local vegetable vendor using UPI. The vendor's name pops up, you type in 50 rupees, you hit send. That is a low-stakes, very simple transaction.
Super easy.
Right. It is an entirely different, infinitely more complex proposition to navigate a multi-page government tax portal to claim a refund, or to handle the friction of complex bureaucratic documentation where a single mismatched digit in your Aadhaar number can freeze your entire bank account.
Ah, I see. The stakes are completely different. A failed UPI transaction for tea is annoying. A failed pension application means you don't eat.
Exactly. Furthermore, the digital utopian vision ignores the stubborn reality of the cash economy.
The cash is still there.
Very much so. Even with soaring digital adoption, the absolute volume of cash circulating in rural areas remains massive. Agricultural laborers are often paid in physical cash. Small merchants deal in physical cash.
And you can't push cash through a smartphone screen.
An app, no matter how beautifully designed, cannot accept physical paper notes and magically digitize them into a bank ledger. You absolutely require a physical intermediary to act as the cash in and cash out terminal. You need someone who can take the physical notes, count them, deposit them into their own digital system, and transfer the equivalent digital value to your account.
That makes a lot of sense. The human API is handling the physical cash transfer and providing the psychological safety net. Like, did it go through? Can I have a printed piece of paper proving it went through?
Exactly. The market for BLSE isn't just the shrinking demographic of people who don't own smartphones. Their market heavily includes people who own smartphones, who use WhatsApp daily, but who just lack the digital confidence to execute formal, high-stakes, bureaucratic, or financial tasks on their own without a trusted guide looking over their shoulder.
Okay, so the need is very real, and the scale of 130 million transactions proves it. But when a company is charging tiny incremental fees per transaction, maybe just 10 or 20 rupees a pop, they need a monstrously large pond to fish in to generate real corporate revenue.
A massive pond.
We need to look at the total addressable market, the TAM. How big is this pond, really?
The sources provide a highly detailed sizing of this market, broken down by the three service lines we just explored. Let's look at the business correspondent services first, the last mile banking.
Okay.
The gross transaction value, which means the total absolute amount of money actually flowing through these assisted banking points across the country, is estimated to be between 15,000 crore and 40,000 crore rupees annually.
To put that in perspective, that is an ocean of capital moving through tiny storefronts.
It's massive.
But BLSE doesn't get to keep that 40,000 crore. That's just the water flowing through the pipes. They're just the toll collector.
Exactly, which is why the gross transaction value is a vanity metric.
Right.
The metric that actually dictates their business potential is the monetizable operator fee pool. That is the sliver of commissions paid by the banks to the operators. For BC services, that addressable fee pool is roughly 2,000 crore to 6,000 crore rupees per year.
Okay, so a massive 2,000 to 6,000 crore rupee pie just for the banking side. What about the e-governance side, the PAN cards and government forms?
The broader ecosystem for government-to-citizen services is vast, with a gross value estimated between 10,000 crore and 30,000 crore rupees.
Okay.
But again, zooming in on the direct operator fee pool, the actual revenue that aggregators like BLSE can compete for, we're looking at roughly 1,500 crore to 5,000 crore rupees annually.
And then we have the third bucket, the value-added retail services, the insurance cross-selling and travel tickets.
That operator fee pool is projected to be in the 3,000 crore to 10,000 crore rupee range.
Wow, that's the biggest one.
It is. If you step back and combine all three of these segments into one macroeconomic view, you are looking at a gross transaction value scaling from 25,000 crore to over 1,000 crore rupees.
A lakh crore.
Yes. But the realizable fee pool, the actual total addressable market for revenue, sits squarely in the range of 6,500 crore to 16,000 crore rupees.
16,000 crores. That is a massive ceiling. But let's ground this for you listening. A massive TAM on a slide deck is great for raising venture capital, but does BLSE actually need to dominate this entire market to be wildly successful? Do they need a monopoly?
Not at all. The beauty of a highly fragmented, geographically dispersed market is that to be highly profitable, BLSE doesn't need to capture 80% of that 16,000 crore rupee fee pool.
Right.
They don't need monopolistic dominance. They just need to capture and defend a disciplined, growing slice of it. And the opportunity to capture that slice is vast because current penetration is wildly uneven.
Uneven how? You mean the difference between cities and villages?
Yes, urban areas are essentially saturated. They are highly penetrated by self-serve technology and dense traditional bank branch networks.
Yeah, if you live in Mumbai, you probably haven't walked into a physical location to pay a utility bill in a decade.
Exactly. But rural and semi-urban areas, where the vast majority of the Indian population actually resides, are severely underpenetrated. They are ripe for these assisted services.
And there is a larger structural force driving this demand, isn't there? The government isn't just passively waiting for people to digitize. They are actively forcing the issue through the push for formalization.
The formalization of the Indian economy is perhaps the single biggest tailwind for BLSE.
It's huge.
The government is systematically closing loopholes and pushing the informal, cash-in-hand economy into formal tax, banking, and welfare systems. If a farmer wants to receive a government agricultural subsidy, it can no longer be handed out in cash by a local official.
Right. The days of cash handouts are over.
It must be routed directly into a formally registered KYC-compliant bank account. If you want to operate a small local business and interact with suppliers, you're increasingly required to have a PAN card and GST registration.
So the government is mathematically forcing the volume of these service interactions to explode. You literally cannot participate in the modern Indian state without interacting with these digital systems.
You're locked out otherwise.
Let's think about the transaction density of a single citizen. 10 or 15 years ago, a citizen in a remote village might interact with the formal state apparatus maybe once every few years.
Maybe to vote or to get a massive physical document?
Right. Now, that exact same citizen might need to interact with the national identity system to verify their mobile phone plan, the tax system for their small business, the welfare portal for their subsidies, and the banking system multiple times a month just to manage their cash.
The frequency of interaction has skyrocketed. You are moving from a single touch point per decade to dozens of touch points per year, per citizen.
It adds up fast.
And at just 5 rupees, 10 rupees, or 50 rupees per transaction in operator fees,
Yeah.
when you multiply that by hundreds of millions of citizens who absolutely require human assistance to complete those required tasks, the cumulative revenue pool becomes staggering.
It's the ultimate high-volume, low-margin play. Which brings us to the most critical operational part of this deep dive. We understand the sheer, overwhelming volume of transactions happening, but how does the engine actually work?
The mechanics of it.
Yeah. How does a corporate entity extract actual, meaningful profit from a 5 rupee fee while paying for staff, electricity, and servers? Let's take a hard look at their unit economics.
To understand how they survive on microtransactions, you have to break down the specific revenue drivers and the cost buckets of a single touchpoint.
Okay, lay it out.
On the revenue side, the bulk of the income is per transaction commissions. Every time money moves or a form is submitted, a tiny sliver of revenue is generated. They also earn some fixed monthly fees or network registration fees from the banks just for maintaining the physical presence in a target region.
So money trickles in drop by drop. Where is it leaking out? What does it cost to run this human API?
The costs are very specific to the physical nature of the model. The largest direct cost is the agent payout.
Right, the guy actually running the store?
Yes. BLSE doesn't keep the whole 10 rupee commission. They have to share a significant portion of it with the local merchant who is actually manning the store, paying the rent, and dealing with the customer.
Because if they don't give the agent a fair cut, the agent just shuts down the computer and goes back to selling groceries full time.
Exactly. Then you have the technology and platform costs. The digital pipes connecting the storefront to the government servers have to be secure, compliant, and constantly updated.
You can't skimp on server security when you're handling Aadhaar data.
No, absolutely not. You also have physical cash handling logistics. Moving large amounts of physical cash from a rural village back into the formal banking system involves security and transportation costs.
Right.
And crucially, you have massive fraud control, auditing, and compliance costs.
Because whenever you have thousands of individual agents moving millions of dollars in cash, the incentive for local fraud is immense.
Which is why supervision is a massive cost center. When you net all of these expenses out, the agent payouts, the tech, the compliance, the sources indicate that a typical mature steady-state network might operate on margins of around 10% to 15%.
Okay, 10 to 15%, not bad.
But here's the catch. During rapid expansion phases, when the company is aggressively setting up new stores, training fresh agents, and expanding into new districts, those margins can compress dramatically, dropping down to the 5% to 8% range.
Let's hold on that margin compression, because this is where the concept of operating leverage becomes the most important phrase in this entire deep dive.
It really is.
How does adding more stores actually impact their bottom line?
Operating leverage is the absolute key to understanding their profitability. The costs of establishing a BLS store or enabling a new touchpoint are semi-fixed.
Semi-fixed.
You have to secure the physical space, purchase the computing hardware, install reliable internet, and often pay the local agent a base minimum guarantee just to make it worth their time to learn the system.
Right. Whether one person walks in that day to check their bank balance or 200 people walk in to apply for passports, the electricity bill, the hardware depreciation, and the core software license costs remain exactly the same.
Exactly.
Yeah.
So until a specific storefront hits a certain volume of transactions, it operates at a loss or just breaks even.
It's a sinkhole until it hits that volume.
Right. The magic only happens once those fixed costs are covered. After that break-even point, every additional transaction flows almost entirely to the bottom line. This is why cross-selling is the lifeblood of the model.
It's the classic supermarket strategy.
Yes, exactly.
Think about how a massive grocery chain operates. They sell you staple items, a gallon of milk, a dozen eggs, a bag of rice, at practically zero margin. Sometimes they even take a loss on them.
Just as a loss leader.
Why? Just to get you to walk through the sliding glass doors. But they make their real aggressive profit margins when you are standing in the checkout aisle, bored, and you impulsively grab a glossy magazine, a highly marked up pack of batteries, and a candy bar.
The analogy holds up perfectly. In the BLSE model, the foundational services, the basic cash withdrawals, the mandatory government form submissions are the milk and eggs.
They just get you in the building.
They generate footfall. They produce tiny basic commissions. But the company seeks its higher margins through the value-added services, the microinsurance policies, the travel tickets, the assisted e-commerce.
Right.
If a local agent can sell a basic health insurance policy to a farmer who originally just came in to update his Aadhaar card, the customer acquisition cost for that insurance sale is effectively zero.
Zero. Because the government's bureaucratic mandate already forced the customer to walk into the store, they didn't have to spend a single rupee on advertising to get that farmer in the room.
It's a beautiful setup.
But this highlights a terrifying vulnerability. They are completely, utterly dependent on transaction density. If they open 1,000 new stores, but those stores are mostly empty, they are just bleeding cash.
And that is the tightrope they walk during expansion. When they launch 100 new touchpoints in a new state, their overhead increases immediately. They have to hire regional managers, deploy compliance audits, and pay software licenses from day one.
The meter is running.
Yes. If the local agents in those new stores fail to generate high transaction density, if they only process a few forms a day and fail to upsell any insurance, those touchpoints become a severe drag on the overall corporate profit margin.
So growth can hurt them.
Growth can actively destroy their profitability in the short term if it isn't matched by immediate density.
We'll see how that exact dynamic is playing out right now when we look at their latest financials a bit later. But we also need to talk about cash flow. The sources describe them as an asset-light business.
Right.
They don't have to build multi-billion-dollar semiconductor fabs or buy massive fleets of delivery trucks. They don't own the real estate of these thousands of local shops. So their capital expenditure is incredibly low.
Very low capex.
By all traditional logic, an asset-light business with massive volume should be swimming in free cash flow, right? Cash comes in from the citizen, they take their cut, they pass it on.
In theory, asset-light models are cash flow machines.
Mm-hmm.
But the reality of this specific ecosystem is dictated by the agonizing timing of
The
payments.
timing. Okay.
You have to ask, what happens if the state government partners or the massive, slow-moving public sector banks delay paying BLSE their aggregated commissions?
The citizen gets their service instantly at the storefront. The agent does the physical work today, but the government bureaucracy doesn't settle its accounts with BLSE until the end of the quarter.
Exactly. And BLSE cannot afford to tell its local agents, hey, we will pay you your cut when the government eventually pays us.
If they do that, the local agent quits on the spot.
They'd walk out.
Mhm.
So BLSE has to pay the local agent their share of the commission almost immediately to maintain trust and keep the network functioning.
Wow.
But if the government takes 60 or 90 days to pay BLSE the gross commission, the company is suddenly forced to carry that massive working capital burden themselves.
That is a brutal squeeze. They have to front the cash to keep the army of agents happy while waiting on bureaucratic invoices to clear. So the engine room hums beautifully if the stores are packed with people buying insurance and the government pays its bills on time.
It's a big if.
But it chokes if foot traffic drops or receivables stretch out, which inevitably makes me wonder, if this model is so asset-light and the cross-selling is so lucrative when it works, why hasn't someone else just crushed them?
The moat question.
Yeah, why doesn't a massive tech conglomerate or a heavily funded Silicon Valley startup with billions in venture capital just swoop in, build a much slicker app, offer the local agents a slightly higher commission, and steal the entire market overnight? What is their actual moat?
That is the fundamental question for anyone evaluating this space. And the answer is entirely counterintuitive. According to the deep analysis in the sources, BLSE's true differentiator, their actual defensive moat, is absolutely not superior software.
That is wild. They are fundamentally a tech-enabled aggregator, but their technology isn't their advantage.
Technology in this space is completely commoditized.
Really?
Yeah, any well-capitalized competitor could hire a farm of developers and build a functionally identical portal or an app over a long weekend. The software is merely the basic enabler.
Okay, so what is the moat?
The core moat that protects BLSE consists of three highly physical, intensely operational elements. First, their distribution network.
Yeah.
Second, their ecosystem integration. And third, their network density.
Let's tear those down one by one. First, distribution. What makes their distribution so defensible?
It is a massive physical merchant network that is built entirely on local trust. And you cannot replicate local trust with lines of code.
That's a great point.
A new tech competitor might have a brilliantly designed app, but recruiting, training, and most importantly, retaining tens of thousands of reliable local agents in semi-urban and rural districts takes years of grueling, on-the-ground operational grinding.
It's physical combat, not digital warfare.
Exactly.
To expand, you literally have to send a human being into a village, find the guy who runs the most trusted local grocery store or pharmacy, convince him that your brand is reliable, teach him how to use your biometric scanner, and trust him to represent you to his neighbors. You can't hack that process. It just takes time and sweat.
Precisely. You are building human infrastructure. Then you have the second element, the ecosystem. BLSE is deeply embedded in complex, compliance-heavy relationships with its parent group, BLS International, and various government workflows.
Right, because state governments and massive public sector banks don't just hand over the biometric data and financial access of millions of citizens to the newest startup that just launched yesterday.
Never.
They want established, audited, certified partners who have a track record of handling bureaucratic red tape without creating a giant scandal.
Government and citizen service ecosystems are fortified by compliance, rigid approvals, and established trust. Gaining access and credibility inside these public service workflows is agonizingly difficult for a new entrant.
It's a bureaucratic moat.
Yes. Once a government integrates its backend with BLSE systems and conducts all the security audits, the institutional inertia to switch to a new provider is massive.
Nobody wants to rip and replace that.
And finally, the third element of the moat is network density.
This comes back to local convenience, right? The physical proximity to the user.
Yes. In underserved markets, convenience is king. Users will walk to the nearest trusted point for a cash withdrawal or document support. If BLSE has already identified and secured the best, most centrally located merchant in a specific semi-urban hub, a competitor has limited options.
They're boxed out.
They either have to set up their agent further away, which means they lose the foot traffic because it's less convenient, or they have to try and outbid BLSE for that exact same prime agent by offering massive financial incentives, which immediately ruins their own unit economics.
Okay, I see the operational strength, I see the sweat equity, but I am going to push back hard on this idea that the moat is impenetrable.
Go for it.
Because when you describe this network of local shop owners putting up a sign and using a portal, it sounds exactly like a glorified franchise network.
Okay, I see the comparison.
Like a fast food chain. You find a local guy, you give him your branding, you give him the cash register, and you take a cut of his sales. If that local agent gets a better commission offer from a rival company tomorrow, what stops him from just ripping down the BLSE sign, putting up a competitor sign, and taking his entire customer base with him? The customer is loyal to the local guy, not the corporate logo.
I will concede that the structural lock-in is weaker than in, say, enterprise software,
Yeah.
but you are severely underestimating the inertia of trust and operational habit.
Really, habit is that strong.
The sources themselves analyze these switching costs and categorize them as weak to moderate. So yes, a local citizen isn't locked into BLSE the way a Fortune 500 company is locked into Amazon Web Services. If the local agent switches platforms, the citizen probably won't even notice. They just want their form processed by the guy they know.
So the moat is fragile at the agent level?
It is fragile if you view it purely transactionally. Would consider the agent's perspective. Switching platforms means learning a new interface, migrating their working capital, potentially losing a few days of business during the transition, and risking that the new platform might have slower server uptimes or worse customer support when a transaction fails.
Oh, that's true. If the new system crashes, they look bad to their neighbors.
The operational friction for the agent to switch is high enough that they won't do it for just a marginally better commission. The moat isn't an impenetrable wall of patented technology. It is a dense thicket of local relationships, bureaucratic approvals, and operational habit.
Which means they can't just rest on their laurels. If your moat is operational and built on habit, you have to keep moving.
Constantly.
You have to keep building, keep acquiring, keep expanding to stay ahead of anyone trying to hack through that thicket. And that brings us to their growth engine. Given that their defense is built on intense physical operations, how does a company like this actually scale up their revenue over the next 5 to 10 years without the entire operational structure just collapsing under its own weight?
The sources outline a surprisingly practical, multi-pronged growth roadmap. They aren't pivoting to try and invent a brand new business model. They are hyper-focused on compounding their existing operational levers.
Okay, what are the levers?
The four most credible growth vectors identified are deeper penetration of existing categories, aggressive geographic expansion, digital shift, and premiumization.
Let's tackle those. Deeper penetration seems obvious. It just means squeezing more juice out of the existing lemon, right?
It means capturing more share of the current demand. If a local agent is currently processing 50 transactions a day, how do they get them to process 75? Can they run local awareness campaigns so citizens know they can pay their electricity bill there instead of just withdrawing cash?
So making people aware of the cross-sell.
Right. It's about maximizing the utilization rate of the physical assets that are already deployed.
Simple enough in theory. But the second vector, new geographies, is where this gets wildly ambitious. The sources mention expanding into Europe, the Middle East, Africa, and they specifically highlight Latin American locations like Colombia and Peru.
Yeah, that's a big move.
This seems like a massive leap. Wait, Colombia? Peru? Why there?
This is where their connection to their parent group, BLS International, becomes their strongest asset. The global trend of governments outsourcing citizen services is accelerating rapidly. It isn't just an Indian phenomenon.
But why? Why wouldn't the government of Colombia or Peru just handle their own citizen intake? Why outsource it to an international conglomerate?
Because the sheer administrative cost and the compliance burdens of identity verification are rising worldwide. Governments are realizing that staffing massive, highly inefficient public offices just to intake physical documents, verify identities, and capture biometrics is a terrible use of public funds.
It's just a drain on their budget.
It is significantly more efficient to use standardized, audited private vendors to handle that entire front-end intake process. BLSE, through its broader group, already has the exact operational playbook for this. Replicating a proven intake model in a new country that has similar government outsourcing needs is a highly credible path for massive revenue growth.
Let me stop you there, because the execution risk sounds terrifying.
It's not trivial, that's for sure.
If you are moving from operating in rural India into places like Colombia or Peru, you aren't just adding more stores in familiar territory. You are dealing with foreign labor laws, massive currency exchange fluctuations, and entirely different political regimes, and totally different cultural expectations regarding privacy and digital trust.
All valid points.
The banking infrastructure in Latin America operates on different rails than India's UPI system. Isn't this an incredibly risky distraction compared to just digging deeper into the Indian market?
You are absolutely right to highlight the execution risk. Geographic expansion of a physical operations network is rarely as seamless as the corporate spreadsheet predicts.
The spreadsheets make it look easy.
They really do. The complexities of local compliance, language barriers, and managing a remote international workforce are immense. However, the core underlying competency, the ability to bid for a complex government tender, set up a highly secure physical intake center, and process standardized documents with low error rates is universally applicable.
The core skill is the same.
Yes, the operational complexity is high, but the strategic reward is geographic diversification. If the Indian market faces a sudden, severe regulatory crackdown, having operational revenue streams in Latin America or the Middle East provides crucial stability to the balance sheet.
They are hedging their regulatory bets. Okay, that makes strategic sense. What about the third lever, the digital shift?
The digital shift is all about automating the physical processes to claw back some margin. The human API is expensive.
Because humans are slow.
Right. If they can implement automated document intake, online appointment scheduling, and digital pre-screening using basic optical character recognition before the citizen even walks up to the counter, they reduce the time the agent spends on each transaction.
So they are using software to make the human API faster, less error-prone, and capable of higher throughput.
Exactly. Taking the existing manual labor and optimizing it. And finally, the fourth vector is premiumization.
I like the sound of this, adding the velvet rope to the bureaucratic process.
Yes. Creating premium lounges, charging express processing fees where local regulations permit it, or offering white-glove, concierge-level assistance.
Give me an example of how that works.
Think about it. If a citizen needs a passport renewed urgently for an unexpected trip, and they are willing to pay an extra fee to wait in an air-conditioned room with dedicated one-on-one assistance rather than standing in a chaotic line, capturing that premium margin is highly lucrative for the operator.
It's the classic airline model. The economy seats cover the fuel, but the first-class seats generate the actual profit. And it seems BLSE is more than willing to simply buy their way into these growth vectors, rather than building every single piece from scratch. The sources detail some aggressive capital deployment recently. In 2025, they acquired a majority stake in Fidelis Solutions. They also made a binding offer to acquire Atyadi Technologies for an equity value of 154 crore rupees.
Those specific acquisitions are massive indicators of their capital allocation strategy. They are aggressively using their balance sheet and their access to capital to buy top-line growth.
Buying it rather than building it.
Yeah, they are consolidating a highly fragmented market by acquiring smaller, regional players who already have established merchant networks or specialized technological capabilities. It allows them to bypass the grueling years-long process of manually recruiting thousands of individual agents in new territories.
It's the land grab. If the market is formalizing fast, you buy the smaller players before a competitor does. Even if integrating their different software systems and agent networks, it's going to be a massive headache down the line.
And it will be a headache.
But the sheer aggression, the reliance on buying growth, the heavy dependence on massive government contracts, the sheer operational weight of managing over 100,000 human touchpoints. It brings us to the final and perhaps most critical phase of our analysis.
The risks.
We have to look at their Achilles heel. We know how they plan to grow, but what are the existential threats that could derail this entire engine tomorrow?
Every high-growth business has a weak point, and BLSE's vulnerabilities are glaringly clear when you look at the structure of their partnerships. The primary downside risks fall into three distinct categories: regulatory and partner concentration, e-governance tender risks, and the long-term threat of technology disintermediation.
Let's dissect the first one, regulatory and partner concentration. This seems tied to the fact that they don't actually own the product.
Precisely. We connect this to the bigger picture. We have to remember that BLSE doesn't actually own the end demand. They're a permissioned middleman.
A middleman.
Their entire business model operates at the absolute mercy of the Reserve Bank of India's regulatory frameworks and the internal policies of massive public sector undertaking banks.
Right. So if the State Bank of India suddenly holds a board meeting and decides, you know what? We're spending too much on these last mile networks. We are cutting the commission we pay our business correspondents by 30% across the board. BLSE just takes a massive direct hit to their top line.
Immediately.
They don't have the leverage to say no. They can't threaten to walk away because the bank has all the power.
They have zero pricing power against the major banks. If compliance rules tighten, requiring more expensive biometric hardware, or if a bank unilaterally changes its payout structure, the underlying economics of BLSE's entire physical network can deteriorate overnight.
That is terrifying for an investor. What about the e-governance tender risks?
Government contracts in India, and globally really, are almost entirely won through fiercely competitive bidding processes. It is a brutal, hyper-price-sensitive arena.
Race to the bottom.
When a 3-year contract to manage state identity services comes up for renewal, BLSE might face a competitor who is willing to take a loss just to win the market share. To keep that contract, BLSE might be forced to bid significantly lower.
Which means they might retain the contract, the top-line revenue might look stable or even grow, but the actual profit margin gets squeezed down to near zero.
Exactly. The buyer in this scenario is the government, and the government's primary mandate is cost efficiency for the state, not protecting the profit margins of private vendors.
And then there's the third risk, which feels like the most existential, looming threat over a 10-year timeline. Technology disintermediation.
This is the risk that the very problem BLSE was built to solve simply ceases to exist.
Right.
It is the risk that India's digital public infrastructure gets so flawlessly good, so frictionless, and so universally accessible that citizens bypass the assisted physical centers entirely.
The day the API is no longer needed because the two software systems finally speak the exact same language natively.
Yes. If state government portals evolve to become universally user-friendly on even the cheapest smartphone, and if remote digital identity verification becomes absolutely foolproof from a citizen's living room, the core value proposition of walking into a physical touchpoint weakens dramatically.
So, if we want to break the story, if we want to envision the ultimate nightmare scenario for BLSE, it's not a standard macroeconomic recession, is it?
No, not really.
Because even in a severe recession, people still need bank accounts, they still need to withdraw cash, and they desperately need to file government forms for welfare support.
A traditional economic recession is not the primary threat here. In fact, welfare distribution might even increase their transaction volume during a downturn.
Oh, that's a good point.
The true break-the-story scenario is a perfect storm of microfactors coalescing simultaneously. Government portals becoming universally self-serve, major banks slashing partner commissions to save their own costs, and local wage inflation squeezing the margins so tightly that the local agents decide it's no longer worth their time to run the terminal.
That is a brutal combination for an operator. And frankly, we don't even have to look into a hypothetical, distant future to see some of these immense pressures at play. We can look right at their recent real-world financials.
The FY26 numbers.
Yes, the sources provide a reality check from FY26 that is completely fascinating. Let me read these numbers to you because they highlight exactly what we've been discussing. In FY26, sales absolutely exploded. Top-line revenue grew by a staggering 115.23% year over year, hitting 11,117.79 crore rupees.
That is massive top-line growth. It proves the demand is absolutely there.
Over 100% growth. But wait, here's the catch. Net profit only grew 9.4% to 57.50 crore rupees. Let that sink in. Revenue more than doubled, but profits barely inched forward. And on top of that, debtor days, which is the metric measuring the time it takes for them to actually get cash in hand from their government and bank partners, increased from 41.2 days to 65.7 days. So wait, let me get this straight. They are doing twice the volume of business, their profits have flatlined, and their massive partners are taking significantly longer to actually pay them. How is this sustainable?
This is the exact manifestation of the operating leverage trap we discussed during the unit economics segment. You are looking at severe, rapid margin compression. According to the deep analysis in the sources, their net margin collapsed from 14.8% down to just 6.4%.
Wait, revenue doubled, but profits barely move, and it's taking them significantly longer to get paid. They are doing twice the physical work, processing twice the forms, managing twice the headaches for half the profitability per transaction.
Essentially, yes. Now, it is important to contextualize this. This financial profile is highly typical of a business in a hyper-aggressive scale-building phase.
Right, they're buying up the market.
They are likely expanding the network massively, funding those acquisitions we mentioned, and setting up thousands of new touchpoints. That aggressive expansion requires heavy upfront costs, marketing, agent onboarding, legal fees, technology integration. All of those costs are hitting the income statement immediately.
And those expansion costs eat directly into the bottom line, suppressing the profit even as revenue surges.
Furthermore, the increase in debtor days is a major red flag for their working capital. When debtor days stretch from roughly 41 days to almost 66 days, it means the company is having to finance its own.
Which perfectly shatters the myth that an asset-light model is a magical guarantee of endless free cash flow. If you grow your top-line revenue by 115%, but your clients take an extra 3 weeks to pay you, you are burning through massive amounts of cash just to sustain the illusion of growth.
It is the harsh reality of scaling a physical network reliant on bureaucratic partners. The fundamental million-crore rupee question for anyone analyzing this company is whether this margin compression is temporary, a short-term growing pain while they capture the market and build an insurmountable physical footprint, or if it is a structural reality, meaning the only way to continually win these government contracts is to accept permanently degraded, razor-thin profitability.
And that is the ultimate tension of the business model. Okay, we have covered a staggering amount of ground today. Let's synthesize this entire journey for you. We started by peeling back the layers on a largely invisible yet utterly massive infrastructure layer in India.
The human API.
Right. BLSE is fundamentally making a massive wager. They are betting that even in an increasingly digital, app-driven, smartphone-obsessed world, the last mile will always require a human touch to navigate the anxieties of bureaucracy, the stubborn reality of physical cash, and the strict compliance of the state.
They have clearly demonstrated that the total addressable market is massive, and their triple-digit top-line revenue growth definitively proves that the demand for this assisted service is intensely real and growing.
But as we just saw with the severe margin compression and the creeping debtor days, they face very real, very grounded execution hurdles. Building a defensive moat out of local shopkeepers and government contracts is exhausting, capital-intensive work, and it leaves the company entirely exposed to regulatory whims, delayed payments, and brutal price squeezes.
Ultimately, assessing BLSE means deeply assessing the balance between digital efficiency and human necessity. What stands out to you about that balance? Do you believe that technology will inevitably become so intuitive that it eliminates the need for physical intermediaries? Or will complex bureaucratic systems and financial trust always require a human guide?
It's a profound question, and it leads me to one final, slightly provocative thought to leave you with, something to mull over on your own after this ends. We talked heavily about the threat of digital disintermediation, the idea that better apps and better government portals will replace the agent. But think about the rapid, terrifying advancement of artificial intelligence over just the last 2 years.
Oh, absolutely.
We are fast approaching a point where a specialized AI running locally on a cheap $10 smartphone could perfectly handle exception processing. It could translate complex legal jargon from a government tax form into a local village dialect in real time. It could patiently guide a confused user through a form using natural voice commands, correcting their mistakes gently.
Just talking to the phone?
Yes. If the AI becomes the perfect, absolutely frictionless, zero-cost API, how many years do we actually have left before the entire concept of assisted digital delivery via a physical storefront becomes entirely obsolete? Does the human intermediary eventually vanish into the code? Or, paradoxically, in an age dominated by AI hallucinations, deepfakes, and automated rejections, does a trusted human face behind a physical counter become the ultimate, irreplaceable premium product? We'll leave you to think about that. Thanks for joining us on this deep dive.